ago. So it's going to be a bit of a bloodbath in a lot of ways. So I actually already started noticing quite a few power of sales. So this is just like,
I just did
it's,
one.
yeah, it's coming and it's happening. And yes, it's not on the news yet, but it will be on the news soon.
Hi, my name is Adam Nadler. I'm the owner of Vision Real Estate. Thanks so much for tuning in yet again. We've got a lot to go over because the Bank of Canada has just raised interest rates by a quarter point as expected.
We raised our policy interest rate by 25 basis points to 4.5%, and we are continuing quantitative tightening. Second, if economic developments evolve broadly in line with the forecast we published today, we expect to hold the policy rate at its current level while we assess the impact of the cumulative 425 basis point increase in our policy rate. We've raised rates rapidly, and now it's time to pause and assess whether monetary policy is sufficiently restrictive to bring inflation back to the 2% target.
The tune of what they're saying is a lot different this time because they're signaling that they're looking to pause and wait to see what happens if this is going to bring inflation down further, if they even need to tighten anymore. Now, we all know that quantitative tightening or the raising of interest rates can take some time to have an effect on the marketplace, and it could take anywhere from 6 months all the way to a year and a half in order for us to truly see that effect. So the burning question on everybody's mind is this the bottom? In order to answer this question, I had to enlist the help of someone who is, frankly, I think a lot smarter than I am. And I think that his insight into the marketplace is going to help to shed some light on what's happening. Constantine is a mortgage broker and also a longtime friend of mine. And I wanted to show you a bit of an interview I did with him last week. So this is actually before the interest rate hike just happened, but it's all still very relevant content. If you have any questions or you'd like to speak to Constantine directly, I have put his contact information in the description below. He also goes over where you can find him at the end of this video. And of course, if you'd like to have a chat with me, feel free to click on the link in the description below. That'll connect you to a calendar where you can book a quick time to chat with me at a time that is most convenient for you. Or feel free to just shoot me an email with any question you have to adam@visionrealestate.ca, and I will get you a personal video response within 24 hours. Constantine, thank you so much for taking the time to chat. I wanted to talk about something with you in particular because you're a huge numbers nerd like me, and you actually sent out an email that I got. I think it was, let me see here,
December 31st. You went out right
December,
before.
yeah, 2022 Wisdom in Review. And there were a whole bunch of great graphs and charts and numbers and explanations of things. And it really it caught my eye. So I wanted to ask you a little bit about that and what you think we're going to be seeing moving forward in 2023 with the market, because you have an interesting perspective on it.
Thank you. Thank you. I put a fair amount of time into my reports. I do it twice a year. It's going to become a little more of a habit. It's typically July and December, specifically December 31st, that I like to send something out that will typically give you my opinion as to what happened in the last 12 months, as well as what's to come in the following 12 months. I actually think that it's important to understand that anybody who is looking at rates right now, it's important to look at them on more of a macro level as opposed to just the last 9 months alone. So one of the things that I've been trying to educate people about for the past 12 months is just generally how rates behaved in the past. And if you were to, let's say, take any of the graphs included in my report that show the previous rate hikes, it's actually quite evident that rate hikes have a very similar slope because the mechanics of how they work is quite well identical, and the driving mechanisms behind them are quite well identical, no matter when you really pick them. And the pressures that are typically in place for rate hikes to commence is inflation. That's typically the number one pressure that the Bank of Canada has to deal with when it comes down to managing their rate policy.
Just want to take a quick pause here to ask you to please subscribe to this channel if you enjoy this content, and hit that like button if you'd like this video to get pushed out to more people like yourself.
And so in the last 12 months, we've seen them get quite aggressive, and for a good reason. We had crazy inflation rates throughout the year 2022. We actually ended the year with very little reduction in inflation rate, which typically takes quite a bit of time for to come down. And so a very good indicator for anybody looking at interest rates in year 2023, the very first indicator is how we're doing compared to, well, how well we're doing in terms of inflation before we look at how well we're doing in terms of rates. Because as soon as the inflation rates come down and we see general inflation in Canada specifically, the world inflation we have no control over. But as soon as we see some improvement in inflation in Canada, we'll definitely see rate hikes, well, first of all, stop, and we'll also see them come down in a very specific pattern. So typically what happens is, and I wish I could pull up a graph right now, and maybe we can include it in something like this later. But when you look at the previous rate hikes, including this one, the slope that goes up, how quickly the rates rise, is actually quite fast. And that is because there's typically some sort of pressure, which in this case was both the crazy real estate market appreciation that we were dealing with earlier in the year, as well as the war in Ukraine, broken supply chains, and general world inflation on commodity prices. So with those kinds of pressures, the Bank of Canada had no other choice but to raise the interest rates. And that's exactly what essentially happened in the previous rate hike cycles as well. So if you look like the 80s, the 90s, 2000s, right? There's essentially this crazy slope going up as soon as some sort of pressure appears. And then once it reaches an equilibrium where the interest rate hikes have reached a level where inflation is no longer as crazy as it was before, but it's starting to stabilize, you'll see the rate coast. And that period is not very evident as to how long that is, but on average, it typically lasts about 2 to 3 years based on the previous rate hikes. And that's because that's how long it takes for the Bank of Canada to actually see the impact of rate hikes and inflation management over that kind of a period of time, because any shorter period of time doesn't give you a true picture. And as soon as the interest rates reach a point, sorry, as soon as the inflation reaches a point where it no longer is a big threat, then that's when you see significant rate cuts. And rate cuts, same as rate hikes, happen very fast a lot of the time because they're trying to put out the fire that they've started, right? So let's say they stall the economy to the point where things are getting really rough. So they're starting to throw some fire in the pit to see if they can fire it up. And that's unfortunately how most of these types of things work. And because of their cyclical nature, anybody who is in a variable rate right now or considering variable rate products for the year 2023, I think that we're about to peak. I think actually, in fact, we are about to peak this month. And in my report, I mentioned that in January, I do anticipate one more rate hike of about quarter points, so 25 basis points, quarter percent, sorry. And I have like a small stipulation that we may see one more rate hike in the month of March at the next rate announcement. And I don't know how much of a threat that really is, because if anything, I think that will be mostly like a quarter percent rate hike as well. And it's mostly, if that is going to be installed in place, that's probably because they're trying to ensure that whatever they're about to do in January and whatever the numbers we will see for like employment numbers as well as just the overall inflation numbers, they're actually putting enough effort into it, because Bank of Canada has been bashed many times in the last 12 months for not being active enough and not doing things quick enough. So that's pretty much my projection for the next few months. And I think that I believe that once we have peak, we will coast like every other time. And once we have coasted for long enough and the inflation rate is brought under control, we'll see significant rate reductions and cuts. Probably not for like a good 18 to something months, probably like in 24 months before we'll see significant rate cuts. But there'll be some fluctuation between as well, where depending on bond yield, which is another driving force behind the market rates, we'll see probably some fluctuation like we're seeing right now, where the fixed interest rates actually come down since earlier time in the fall, when they were about 25 to 50 basis points greater than they are right now overall. So that's kind of, I think, the lay of the land more or less.
A lot of people, and especially in the news, I hear a lot of criticism from different economists, basically always saying that the Bank of Canada reacts too late, and then when they do react, that they overreact. How do you feel about that?
Oh, it's 100% correct. In fact, there was a post that I made at the beginning of 2022, and it actually aged quite well. I did it on Twitter, and the post was right after they chose not to increase interest rates in the month of January.
I remember it. It was inflation. Hold my beer.
So I've been talking about how we're not doing enough before the year 22 started, and I was like, okay, if we don't do something like now, you guys are gonna regret this big time. And so when January they did nothing again, I was like, okay, get ready. And so the tweet went out, and most people just ignored it, right? Because nobody was really paying attention. And then once things started taking a turn, when I reposted in July, I had a lot of replies being like, "Okay, you were right."
From what I'm seeing, affordability has not gotten any better,
That's right.
and that the artificial, I guess, softening of prices due to the rate hikes has not put anybody in any better a position to own a home, in
Yeah.
technical terms, and that the inventory being as low as it is and remaining as low as it is for many months now is stabilizing price moving forward. So we're not really seeing any of the, online kind of keyboard warriors spelling doom and gloom. That's, doomsday apocalypse going to happen. That, I mean, that's not even, it doesn't even look like that's in the cards at all. Correct me if I'm wrong.
Okay, so let me just actually unpack the few layers to it. So first, affordability. Affordability has been horrible. It's all throughout last year, and it was just getting worse, right? Because at the beginning of the year, you started with a certain limit for all of your pre-approvals, all of your approvals, all of your renewals, and by the end of the year, you had like good, in some cases, as much as 20% of your capacity just gone. Like I remember when we were looking at $100,000 income, and that was, that was enough to qualify you for a 500,000, maybe 550 purchase. And like the same income now is giving you literally like 450 pricing a year later, right? So that is a big concern. Now there is a way to battle this, and here's what I've been doing with a lot of my applicants in the last few months, actually all throughout 2020. This has been a really big game changer. So this is not very well known in the retail market, but besides the main bank product that you see with TDs and Scotias and the likes of that world, there's other tiers of lending. And those tiers of lending offer you significant liberties when it comes down to qualifying for greater loan amounts and being able to qualify for a purchase that you can perhaps keep for a few years as opposed to just buying and flipping a year later because it's not what you want. And what we started doing in the last years is started looking at these alternative tiers, and the tiers go like this: you have your triple A tier with TDs and Scotias and the likes of that world. You have your Alt A tier, which is credit unions for the most part, and you have your B tier, which is or third tier, which is mostly trust companies actually. And so the important thing is that those who are in a position to count with 20% of whatever they're buying, yes, the payments will be higher because the interest rates are high right now. But those people who have 20% down have actually a unique opportunity where the market is perhaps dry on offers and you have a lot less buyers to compete with. And if you're willing to work through these other tiers that are typically a little bit more expensive, you often can qualify for quite a bit more funding. So in cases, let's say, of credit unions, they don't actually use a stress test. And not a lot of people know this. It's not every product that they don't use a stress test, but there's a number of broker channel products that we have as a brokerage that is available through credit unions and is specifically designed to give you that additional 20%, 25% of purchasing capacity that you lost last year. That this actually exists. And on top of that, there's also the third tier that I just mentioned, the trust company tier, that also has like 35-year amortization. It also has 40-year amortization as of not so long ago. And this is also not well known, but these are the remedies that we have to perhaps make affordability at least manageable, right? Like, okay, 30-year AM is one set of payments, 40-year AM is a different set of payments. Even at a greater interest rate, that still makes a big difference and is worth considering as a strategy at buying something that you want and you want to keep for a long time. And it allows you to enter the market perhaps this year, 2023, when you find something that's going to be at a good price and it's in the right area and there's not like 100 offers on that property. So it actually is creating a bit of an opportunity. So as much as affordability is a big concern, especially for first-time buyers, because there are no programs of this kind for anybody with less than 20% down. This is the very first thing I said. 20% down really liberates you and gives you options that you just don't have otherwise. So another strategy that I've been using in the last 6 to 12 months, I've actually been using parents, not so much as co-signers, because most millennials are making quite good money at this point in their lifetime. And we're using actually their parents to provide the additional down payment as a gift, so they can actually afford buying a property of their dreams or to start a new family, whatever the case may be. Now that the opportunity is available to them and they are able to service the debt. It's just that, like I said, the interest rates are a bit high, So the entry pricing, the entry point for this market is a bit greater, and the entry payments are a bit greater. But then again, these are cyclical things, and as the rates come down, those people will get to keep those properties and keep the appreciation, whatever the appreciation may be, by the time that the new renewal comes due. In terms of other things that they can do is, for affordability, you can also actually just look at this is just again an idea. I've seen people also look at triplex and fourplex properties, kind of as a joint purchase. That's also an idea on how to reduce cost of housing. For the most part, triplex and fourplex properties are rather expensive in Toronto. But if it's not directly in Toronto, there are some areas in GTA where you can look at multi-unit properties that could be used, maybe in like a multiple purchaser scenario where there's maybe one or two families or three families looking to buy it. It's not completely unusual. It's a little unusual, but it's also another remedy on in terms of creating opportunities for affordable housing in a way.
So if the Bank of Canada is signaling that they're going to be pausing and waiting to see what happens, and we know that we have extremely low inventory going into the spring market, it is very possible that we don't see any price drops. However, there has to be some give somewhere, and this is where I think Constantine brings up a really good point as to where you can find an amazing angle, an amazing deal in this marketplace moving forward.
The renewals coming up on the private lending market in Q1, Q2 2023 is going to be a bit of a bloodbath because there's a lot of mix. I shouldn't say a lot. There's a number of mix that are very prominent in the lending community and that are very often used, who have a policy that on renewal, when you lend, let's say, a second mortgage up to 80% loan to value, on renewal, you have to get an appraisal so you can confirm your equity position so that you know that the risk tolerance for your MIC is appropriate. Here's a problem. If you refinance your property at the beginning of 2022 and you captured your value at the very peak of that of the values in 2022, the renewal terms may not be available to you because the appraisal might confirm negative equity. And if that happens, I do anticipate a lot of lenders will just call their loans and those properties will land on the market. And that's all going to be happening throughout February, throughout March, and April. And yes, a lot of those people won't first do it. It might take a little bit of time because even in the case of a power sale scenario, it all takes time. It's not something like, you miss your payment, then the bailiff comes and then takes your keys and kicks you out. Like this all takes time. So even if, let's say, it takes the duration of 3 to 6 months to get possession of some property that's not that where the owner isn't looking to sell that property by themselves, and now it just has to go through this rigorous action where there is now a lender involved and there's a bunch of lawyers involved and people are trying to figure out a way of disposing of it, but as fast as they can. Like we'll see a lot of inventory in the market that's going to be forced onto the market in the next few months, and public doesn't really know this, right? So this is something that you notice if you're in the lending community and you're like, oh, well, that's a problem. So I can talk about a few other issues that are also going to be coming up in the private lending community, and that's also pricing, for example, right? Like a lot of this money that went out in 2020, 2021, 2022 was priced extremely low because everybody was lending money out on leverage. People had super low interest rate on their lines of credit. They were lending it out to people who needed that money so they can do things that they need to do. Those people will not be looking to renew at the same interest rates. It's just not possible. Like there's no way that we can have seen a 400 something basis points run from the Bank of Canada, meaning that all of that leverage money is being now priced higher and not see at least an equivalent, or at least like a big portion of that cost laid back onto the borrowers that are borrowing from those investors that are leveraging their funds, right? So there's like multitude of things that we haven't actually seen hit the market or come into a commonplace and become part of this equation. Once they do, I think that the inventory will get flooded. And once it gets flooded, that's probably when most values will bottom out because it's going to be a lot easier to justify, selling your property when there's 20 other properties in the same, area that have been selling for the past 2 months, and you have to get that money out. So that's my prediction as far as the spring market goes. So it's going to be a bit of a bloodbath in a lot of ways. So I actually already started noticing quite a few power of sales. So this is just like
I just did one.
Yeah, it's coming and it's happening. And yes, it's not on the news yet, but it will be on the news soon.
Yeah, so in terms of power of sale, I mean, I'm very involved in that. I work for a few different private lenders that that have asked me to kind of gear up in the way that you're saying. And I have a few more coming, but these are, as the market goes, far and few between. It's more of a problem where buyers are very, I guess, misinformed or uneducated on what a power of sale is and
Mm.
how those things work. So they always think, hey, this property's been forced onto the market, it's going to be an amazing deal. But these B lenders have obligations to satisfy the lenders that have more priority over them. So that can create big problems because those first or second lenders that have priority end up racking up additional fees and all kinds of stuff. A lot of those people did end up refinancing when market was crazy on their firsts and seconds before they went to the third, or first before they went to the second. So I think that they may be forced onto the market. I don't know how good of a deal they're all going to be, but it is interesting to see that for the first time in a really long time, at least in my career, for the Toronto real estate market, we're seeing um, a greater number of properties being forced onto the market. So that is very interesting. Um,
You were here in 2017. You know how quickly that tide turned. So
it
like,
it turned back very quickly. Like it didn't
yeah,
really last.
it turned back very quickly. But I mean, so I'm not saying that we're going to see the entirety of 2023 just power of sales and is going to be like real estate Armageddon here. I think actually it's more going to be like very, again, cyclical and like very um um very isolated. Like these things will happen, and then once it cleared the queue and all those things are gone, then now things will have more or less stabilized. And now now that we're more or less true to the equity positions everybody's at, now things are going to more or less probably go back to a more of a balanced market where, I think, again, like I said, all things being cyclical, buyers markets and sellers markets, they're never forever. So if we do see a bit of an opportunity here in the first quarter, a few quarters of 2023, it won't be forever. It's just, again, like I said, it's just while things are on fire. Once they stabilize and a lot of that business is weeded out, I think we'll see things kind of be, again, like I said, normalized, stabilized.
So you're kind of seeing then what I'm seeing, which is that 2023 is the year of opportunity. Is that kind of what your message would be to people? Is that 2023, be vigilant, keep an eye out?
I think that 2023, if you're looking to purchase property uh, and you're looking to buy a first home, I think that's a great opportunity if you're able to service the debt and you're able to get into the market. Again, I'm not suggesting that you should rush into it tomorrow. I think you should actually just kind of sort of maybe work towards your pre-approval, figure out your down payment, work with your broker on figure out your financing, line it up so you have it ready, and then just look for opportunities. Not necessarily trying to catch the very bottom of the market. I actually say look for like areas you're interested in, start researching the areas you're interested in, work with your real estate agent on devising a strategy as to some of the things you're looking for, maybe in areas that are close to it, where there may be opportunities, right? And then like as we see the market sort of unravel, the realtor is keeping in touch with the customer and there's listings being sent to them. When the time comes and the property is right, if the property is being purchased for not just like a 1 year flip, if it's being purchased for 5 years, if it's being purchased to start a family, I think the right time is now. Like whenever you're ready, the time is now, because really, if you're able to afford it, if you're able to start that, get that new home start, and get your own home. I mean, like if the game is long term and you're looking to flip this home and you're looking to stay in it for 5, 10 years, historically you really don't lose on those types of things, right? The question as to what kind of financing you should be getting, I think that's a discussion to be had with the mortgage broker. Um, Sometimes some may be benefiting from variable if their budget allows. Some will probably be looking at fixed and things like that. So I think that opportunity is always present, and so you should probably be looking to at least understand what the opportunity is, be aware of it, and then be ready if it comes up. Anybody who's looking to invest into real estate for flips, I don't have a lot of comments to say. Like I would rather not comment on flips, or I would rather not comment on investment opportunities, because it's just not clear as to like if the person is looking to buy a property for the purposes of, let's say, flipping it a year later because they expect crazy appreciation, like I think that's just not going to happen that fast. I think that if you're investing into a property that cash flows based on whatever down payment you have and whatever the revenues that property generates, and you could hold it for, let's say, a few years. I think that's a good opportunity, right? So I would say short term, no. Long term, yes.
Gotcha. Wonderful. Well, thank you so much for taking the time to chat. You're just a wealth of knowledge, and I really did appreciate your email. It did catch my eye. So I'm always looking for interesting takes on the market that are data driven and evidence based. So really love your approach. Thank you so much. And yeah, hopefully we'll do this again sometime soon.
Thanks, Adam. Just gonna mention it if anybody who's watching this video, if you guys would like to follow me on social media, feel free to follow me on Instagram. That's probably my most active account. It's very simple. It's at the Pocket Broker, just the way it sounds. So at the Pocket Broker, feel free to follow and enjoy the content. Thank you so much.
Thanks, Constantine. Thanks again for watching. I really hope that you found this helpful and that it helped to bring some more clarity to what's going on in the marketplace for you. Don't forget to like and subscribe to the channel, and I will see you next time.
If you like that video, click the subscribe button on the right, or feel free to enjoy another video here on the left.